Top 25 Investment Banking Analyst Interview Questions and Answers. Investment banking analyst interviews can be challenging, often requiring candidates to demonstrate their financial knowledge and analytical skills. This video will present the top 25 questions you may encounter during the interview process, along with comprehensive answers. By reviewing these questions and answers, you will gain valuable insights into what interviewers look for in candidates. Preparing for these scenarios will help you feel more confident and ready to tackle your investment banking analyst interview. 1. Walk me through a DCF, discounted cash flow, analysis. A DCF analysis involves several key steps. First, project the company's free cash flows for a specific forecast period, typically 5 to 10 years. Next, estimate a terminal value to account for cash flows beyond that period, using methods like the Gordon growth model. Discount both the projected cash flows and the terminal value back to the present value using a discount rate, often the weighted average cost of capital, WACC. Finally, sum these present values to arrive at the total enterprise value, which can be adjusted for debt and cash to determine the equity value. 2. How do you value a company? Valuing a company typically involves several methods, with the most common being discounted cash flow, DCF, analysis, comparable company analysis, and precedent transactions. In a DCF analysis, future cash flows are projected and discounted back to their present value using the company's weighted average cost of capital, WACC. Comparable company analysis involves assessing similar firms in the same industry to derive a valuation multiple, while precedent transactions look at historical acquisitions to establish a valuation benchmark. Each method provides unique insights, allowing for a more comprehensive valuation perspective. 3. What are the three main financial statements and how are they connected? The three main financial statements are the income statement, balance sheet, and cash flow statement. 1. Income statement. This statement shows a company's revenues and expenses during a specific period, leading to net income or loss. 2. Balance sheet. It provides a snapshot of a company's assets, liabilities, and shareholders' equity at a particular point in time. 3. Cash flow statement. This outlines cash inflows and outflows from operating, investing, and financing activities. These statements are interconnected. Net income from the income statement affects retained earnings in the balance sheet, while changes in assets and liabilities on the balance sheet impact cash flow in the cash flow statement. 4. What is EBITDA and why is it important? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It serves as a measure of a company's operational performance by focusing on earnings generated from core business activities, excluding non-operating factors. Investors use EBITDA to assess profitability, as it provides insight into operational efficiency without distortions from financing and accounting decisions. It also facilitates comparisons across companies and industries, as it normalizes earnings by ignoring variations in capital structure and tax rates. This metric is often used in valuation multiples to determine a company's worth in mergers and acquisitions. 5. How would a $10 increase in depreciation affect the financial statements? An increase of $10 in depreciation would lower pre-tax income by $10, causing a decrease in net income. Since depreciation is a non-cash expense, cash flow from operations would not be directly impacted by this change. However, the reduced net income would lower taxes paid, resulting in a slight increase in cash flow. On the balance sheet, accumulated depreciation would increase, reducing the asset value. This change will also impact the income statement, cash flow statement, and balance sheet, highlighting the interconnected nature of these financial statements. 6. What is accretion, dilution in an M&A deal? Accretion and dilution refer to the impact of a merger or acquisition on the acquiring company's earnings per share, EPS. Accretion occurs when the combined company's EPS is higher than the acquirer's standalone EPS, indicating a positive financial effect. This typically happens when the target company has a higher P/E ratio or generates significant cash flows. Dilution, on the other hand, happens when the combined EPS is lower, which can occur if the acquirer pays a premium for the target or if the target's earnings are lower than expected. Understanding these concepts helps assess the value created or lost in M&A transactions. 7. Walk me through a merger model. A merger model typically consists of several key components. First, you forecast the financials of both companies involved, projecting revenue, expenses, and cash flows. Next, you determine the exchange ratio based on the valuation of both companies. This includes assessing synergies that may arise from the merger, such as cost savings or increased revenue opportunities. After modeling the pro forma financials, you analyze the impact on earnings per share, EPS, to determine if the deal is accretive or dilutive. Finally, consider the financing structure, which may involve debt or equity issuance, and evaluate the long-term strategic benefits of the merger. 8. What is the difference between enterprise value and equity value? Enterprise value represents the total value of a company, including its debt and excluding its cash. It is calculated as market capitalization plus total debt minus cash and cash equivalents. This metric provides a comprehensive view of a company's value as it accounts for all financial obligations. Equity value, on the other hand, represents the value attributable to shareholders only. It is essentially the market capitalization of the company's shares. While enterprise value is useful for comparing companies with different capital structures, equity value focuses solely on shareholder interests. Understanding both metrics is crucial for accurate valuation and investment decisions. 9. When would you use a leveraged buyout (LBO) model? When considering an investment in a mature company with stable cash flows, an LBO model becomes essential. This approach allows private equity firms to utilize a significant amount of debt to finance the acquisition, amplifying potential returns on equity. LBOs are particularly suitable for companies that possess strong asset bases, predictable earnings, and opportunities for operational improvements. Additionally, LBO models work well when the target company operates in a non-cyclical industry, as this stability ensures that debt obligations can be met effectively. 10. What is working capital and why is it important? Working capital refers to the difference between current assets and current liabilities. It is a measure of a company's short-term financial health and operational efficiency. Positive working capital indicates that a company can easily cover its short-term obligations, while negative working capital may signal financial troubles. It's important because it ensures that a business can maintain its operations, invest in growth opportunities, and meet unexpected expenses. Adequate working capital is essential for smooth operations and long-term success in any business environment. 11. What's your view on the current interest rate environment? In recent times, interest rates have seen significant fluctuations, influenced by central bank policies aimed at controlling inflation and stimulating growth. Higher interest rates typically lead to increased borrowing costs, which can impact consumer spending and business investments. On the other hand, lower rates can encourage economic activity but may also indicate weaker economic conditions. It's crucial for investors to monitor these trends closely, as they affect both equity and debt markets, shaping investment strategies and valuations across sectors. Understanding these dynamics can help in making informed financial decisions. 12. How do macroeconomic trends affect investment banking deals? Macroeconomic trends significantly influence investment banking deals by shaping market conditions, investor sentiment, and capital availability. For instance, rising interest rates may lead to increased borrowing costs, which can deter mergers and acquisitions. Economic growth can enhance corporate profits, making companies more attractive for investment. Conversely, during economic downturns, deal activity often declines as firms become risk-averse. Additionally, factors such as inflation, exchange rates, and government policies can affect valuations and strategic decisions, prompting investment banks to adjust their strategies accordingly. 13. Who are our firm's top competitors? Our firm's top competitors typically include major investment banks such as Goldman Sachs, JPMorgan, Morgan Stanley, and Bank of America Merrill Lynch. These institutions are known for their extensive global reach, comprehensive service offerings, and strong client relationships. Additionally, there are boutique firms like Evercore and Lazard, which focus on advisory services and may compete in specific sectors or regions. Understanding our competitors helps us identify market positioning, differentiate our services, and recognize areas for growth and improvement. Staying informed about their strategies can enhance our competitive edge in the marketplace. 14. What sectors are currently experiencing strong M&A activity? In recent months, several sectors have shown heightened merger and acquisition activity. Technology remains a frontrunner, driven by the push for digital transformation and innovation. Healthcare is also vibrant, influenced by advancements in biotech and pharmaceuticals, especially post-pandemic. Financial services are experiencing consolidation as companies seek efficiencies and scale. Additionally, energy, particularly renewable energy, is gaining traction as firms pivot towards sustainability. Consumer goods continue to evolve, reflecting changing consumer preferences and e-commerce growth. These sectors illustrate a dynamic landscape for M&A, shaped by economic trends and strategic goals. 15. What's the most recent deal you followed? Walk me through it. One recent deal I followed was the acquisition of XYZ Corp by ABC Inc. for $1.2 billion. This transaction aimed to enhance ABC's product portfolio and expand its market reach. The deal structure involved a mix of cash and stock, providing XYZ shareholders with immediate liquidity while allowing them to participate in ABC's future growth. The strategic rationale included synergies in operations and cost savings expected to be realized within 2 years post-acquisition. Regulatory approvals were secured swiftly, and the integration process was initiated, focusing on aligning company cultures and optimizing resource allocation. 16. Tell me about a time you worked under intense pressure. In my previous internship, I was assigned a project with a tight deadline due to an unexpected client request. The task involved analyzing financial data and preparing a presentation for senior management. I prioritized my tasks by breaking the project into manageable sections and setting short-term goals. I communicated regularly with my team, ensuring everyone was aligned and focused. As the deadline approached, I stayed late to finalize the report, incorporating last-minute feedback. The presentation was well received, demonstrating my ability to perform effectively under pressure while delivering high-quality work. 17. Describe a time when you worked in a team to analyze a financial problem. In a recent project, my team was tasked with evaluating the financial impact of a potential acquisition. We began by gathering relevant data from various departments and identified key performance indicators. My role involved analyzing financial statements and modeling different scenarios. Through collaborative discussions, we shared insights and perspectives, which enhanced our understanding of the complexities involved. By aligning our findings, we developed a comprehensive report that highlighted risks and opportunities, ultimately guiding the decision-making process for senior management. This experience reinforced the importance of teamwork and diverse viewpoints in financial analysis. 18. How do you handle long hours and stress? Handling long hours and stress requires effective time management and prioritization. I break tasks into smaller, manageable segments, allowing me to focus on one thing at a time. Regular breaks help maintain my productivity and mental clarity. I also find that staying organized with clear deadlines reduces anxiety. When facing high-pressure situations, I practice mindfulness techniques, such as deep breathing, which helps me stay calm and focused. Additionally, maintaining open communication with my team fosters a supportive environment, enabling us to tackle challenges together efficiently. 19. Describe a challenging project and how you handled it. One challenging project I encountered involved analyzing a distressed company's financial situation for a potential acquisition. The task required extensive data gathering and collaboration with different teams to understand the company's operations and financial health. I initiated weekly meetings to align our approach and set clear milestones. During the analysis, I identified key cost-saving opportunities that could improve profitability. My team and I presented our findings effectively, and our recommendations played a crucial role in securing the deal, demonstrating our ability to navigate complex scenarios and deliver results under pressure. 20. Why do you want to work in investment banking? I am drawn to investment banking due to its dynamic environment and the opportunity to work on high-stakes financial transactions that shape industries. The challenge of analyzing complex financial data and developing strategic solutions excites me. I am eager to collaborate with talented professionals and gain exposure to various sectors, which will enhance my analytical and problem-solving skills. The fast-paced nature of investment banking aligns with my career aspirations, allowing me to contribute meaningfully while continually learning and growing in the finance field. 21. Why this firm over others? When considering why I want to join this firm, I am impressed by its strong reputation for excellence within the industry, particularly in sectors that align with my interests. The firm's commitment to professional development and mentorship is appealing, as it indicates a culture that prioritizes growth. Additionally, the innovative approach to deal-making and the diverse client base offer unique opportunities to engage in meaningful projects. I believe that working here would allow me to leverage my skills while learning from some of the best professionals in the field, contributing to both my personal and the firm's success. 22. Where do you see yourself in 5 years? In 5 years, I envision myself advancing within the investment banking sector, ideally in a role that combines analytical responsibilities with strategic decision-making. I aim to deepen my expertise in financial modeling and valuation while taking on leadership opportunities. I see myself mentoring junior analysts and contributing to high-stakes deals that drive growth for clients. Staying adaptable and continuously learning will be essential as I navigate the evolving financial landscape, ensuring that I remain a valuable asset to my team and the firm. 23. What makes you a good analyst? I possess strong analytical skills, enabling me to dissect complex financial data and identify trends that drive decision-making. My attention to detail ensures accuracy in financial modeling and reporting, which is critical in investment banking. I am proficient in various financial software and tools, allowing me to streamline processes and enhance productivity. Additionally, my ability to communicate effectively with team members and clients fosters collaboration and drives successful outcomes. I am driven, eager to learn, and thrive under pressure, which positions me well for the dynamic environment of investment banking. 24. Tell me about a time you showed initiative. In my previous internship, I noticed that our team was spending a lot of time manually compiling data for weekly reports. I took the initiative to learn Excel macros and created a tool that automated the data collection process. After presenting the tool to my supervisor, it was implemented across the team, significantly reducing the time spent on reports by 50%. This allowed my colleagues to focus on more strategic tasks rather than repetitive data entry. My proactive approach not only improved efficiency but also demonstrated my commitment to enhancing team productivity. 25. What do you read to stay current with financial markets? To stay current with financial markets, I regularly read a variety of sources. Major financial news outlets like the Wall Street Journal, Financial Times, and Bloomberg provide timely updates and in-depth analysis of market trends. I also follow industry-specific publications such as Harvard Business Review for insights on business strategy and market dynamics. Additionally, I utilize financial blogs and podcasts that offer expert opinions and discussions on current events. Engaging with reports from investment banks and research firms helps me understand broader economic factors affecting markets. In this video, we've explored the top 25 investment banking analyst interview questions and their insightful answers. Being well prepared is crucial in the competitive world of investment banking, and understanding these key questions can give you an edge over other candidates. Remember, practice makes perfect, so take the time to rehearse your responses and tailor them to reflect your unique experiences. If you found this content helpful, please like the video and subscribe to our channel for more tips and insights on navigating your career in finance. Your support helps us bring you valuable resources.